talk today about lowering our taxable income. And the first step in the process is taking a look at what's more beneficial to us, taking a standard deduction or itemizing our deductions. The standard deduction is an amount given to us by the government. And for 2025 tax year, it's for a single filer, it's $15,750. And for married filing jointly, it's double that amount, which is $31,500. So if your income, adjusted gross income, is let's say $100,000, you will be able to take that deduction if you're choosing a standard deduction, and then that 68,500, that's your now taxable income. You also have a choice of using an itemized deduction. So an itemized deduction is a pool of expenses that you incurred throughout a taxable year, such as mortgage interest, taxes paid to the state, an investment interest expense, and also charitable donations. And if the total of all those amounts exceed the amount of a standard deduction, then most likely that's the amount you should be going with. Now, there are big changes coming for 2026 tax year. Number one, there's a floor for charitable donations, and the floor limit is 0.5%. So, what does that mean? If, let's say, your income is $100,000, 0.5% of that is $500. So, you will not be able to take that $500 as your charitable donation deduction in your pool of itemized deductions. And it's possible that that $500 will be lost forever, that it won't carry forward. And it all depends if your entire deduction limit, for example, you can take up to 60% of your AGI as a deduction for charitable purposes. So if you don't exceed that amount, then that entire $500 is lost. So there are some calculations that should be done before making a decision of which charitable donations we should be making for 2025 versus 2026, what's more beneficial, maybe bunching them into one year, which probably would be the year of 2025. Maybe that's more beneficial than giving a little bit of money this year and a little bit of money next year. And there's also another change for 2026 tax year, which of course makes a big impact for planning for 2025. And it's a reduction of itemized deduction for high earners. So if any part of your income will reach the 37% tax rate, then you will receive a haircut of about 5.4% from your itemized deductions, and that will not be carried forward. It will be lost. So super important to take a look at it to see if you will be benefiting from bunching your deductions for 2025, how much income to report for 2025, or maybe you can defer some income towards 2026, or the other way around. Prepaying taxes to the state, maybe instead of paying your last quarter 4 in January, maybe it's more beneficial to do it in December, so you can take that deduction, because as you might remember from my previous recording, SALT deduction, which is state and local tax deduction, was increased to $40,000 if your adjusted gross income is up to $500,000. So maybe there is an opportunity there to take a full advantage of that increased limit. Again, it's super important to take a look at it before the end of the year, because as we know, January 1st rolls in and there's not that much left that we can do for the prior year. Until next time.